In 2023, everyone was worried about interest rates going up and causing a recession, but it didn't happen. Now, in 2024, people are crossing their fingers for things to settle down and get back to normal. But, what's normal has kinda shifted lately, and investors need to roll with the changes. Let's check out the important stuff to watch out for. Don't get too used to the super fast 5.2% GDP growth the US had in the third quarter of 2023. That speed was thanks to folks spending money they borrowed. Seems like it might be the last hurrah for households who pretty much used up the government aid they got from mid-2020 to late 2021. Now, based on a survey from the Federal Reserve Bank of Philadelphia, experts think US GDP growth will slow down to 1.3% in 2024. Why? Well, the Federal Reserve started raising interest rates last March to fight inflation, and there are some global uncertainties adding weight to the outlook. But here's the scoop. Most smart minds in economics think the US won't hit a recession. They're talking about a soft landing, which means things slow down, but not too hard. Innes McPhee, the big shot economist at Oxford Economics, even calls it a soft-ish landing. He figures inflation will keep dropping, just not as fast as it did in 2023. And with the job market easing up, he says the Fed might start cutting rates later in the year. Guess what? The Fed spilled the beans this week, saying they plan to start cutting the Fed funds rate next year. It's a big deal because it's the first time in this whole tightening phase that they're hinting at easing up on their fight against inflation. People in the market loved it, and the Dow shot up to a new record. Now, folks are buzzing, thinking the Fed will keep slashing rates in 2024. The odds, according to the CME's FedWatch tool, are around 75% that the Fed will drop the rate by at least a quarter percentage point when they meet on March 20th. And get this, the market is pretty much banking on a 99% chance that the benchmark rate will be at least a whole percentage point lower by the end of next year, with a good 70% chance it'll be a whopping 150 basis points lower. But here's the twist, the market might be jumping the gun. The Fed bigwigs themselves are only talking about a 75 basis point cut, as per the summary of economic projections they released when they announced they're keeping rates steady at a 22-year high. So, let's see how this rate-cutting drama plays out. So, if you're crossing your fingers for those rate cuts to roll in soon, Charles Schwab has a word of caution in their 2024 US outlook. Be careful what you wish for. According to Chief Investment Strategist Liz Ann Saunders and Senior Investment Strategist Kevin Gordon, if the Fed starts cutting rates around mid-2024, it might be a sign that the economy, especially the job market, is taking a hit. They predict that the Fed will shift its focus from battling inflation to dealing with employment issues. Now, here's the worry. If unemployment goes up, it could be a real blow to consumer spending. And you know what? Consumer spending is like the engine that drives 2/3 of the US GDP. So keep an eye on that job scene. It might have a big impact on the economy. So let's talk about the stock market and whether this bull run can keep going. The rebound in 2023 was like the rally that few believed could happen. It actually kicked off in October 2022, and this year, stocks have been on fire, even with stubbornly high inflation. The big players in this game were the Magnificent Seven: Apple, Amazon, Alphabet, Meta, Microsoft, Nvidia, and Tesla, who carried the market, giving investors a breather after the rough ride in 2022, with the S&P 500 up by 23% and the Nasdaq 100 soaring by 42%. Folks are wondering if this momentum will last, or if it's going to follow Newton's first law of motion. Now, what could throw a wrench into this rally? There are a few possibilities. 1. Economic hard landing. If the economy takes a nosedive, with unemployment shooting up and people cutting back on spending, it could lead to a recession. 2. Corporate earnings. Disappointment. If companies start seeing slower sales and shrinking profits, they might lower their forecasts, cut back on share buybacks, reduce dividends, and maybe even lay off more workers. Analysts are optimistic though, expecting S&P 500 companies to hit record earnings in 2024. 3. Stretched valuations. The S&P 500's price-to-earnings ratio is 22 times, and the forward PE ratio is 20 times. According to Jurian Timmer from Fidelity, that's not exactly exactly a bargain, and it gives us an equity risk premium of 3.9%. Caution flags might go up for investors thinking about diving headfirst into stocks. Let's dig into some lessons from history to get a sense of what 2024 might hold for the stock market. According to Ben Carlson from Ritholtz Wealth, when the S&P 500 had gains of 20% or more in a year, it tended to keep adding more gains about 65% of the time in the following years. The average return after a 20% or higher year was 8.9%. Now, considering it's a presidential election year, things might get interesting. First Trust notes that in 19 out of the last 23 election years, that's 83% of the time, the stock market ended up higher. Surprisingly, it didn't matter much which party was in charge. If a Democrat was in office and another Democrat got elected, the average return for the year was 11%. If a Democrat was in office and a Republican won, the average return was 12.9%. Shifting gears to bonds, after a 3-year bear market that knocked down long-term US Treasuries by 25%, a break in interest rate hikes might have stabilized things. But don't expect bond yields to go back to 2021 levels, even though the US 10-year Treasury yield went over 5% in late October 2023. It's now around 4%. But the US balance sheet isn't looking great, with a hefty deficit of $33 trillion. Foreign buyers like the Bank of Japan and the People's Bank of China have scaled back their purchases of US bonds, and the once super safe and widely held asset has lost a bit of its shine. But hey, there's a silver lining for bond enthusiasts. As the US economy settles down and interest rates ease up, Vanguard sees a better outlook for government bonds. They're expecting US bonds to bring in a nominal annualized return of 4.8%, 5.8% over the next decade, which is a significant improvement from the modest returns of 1.5% to 2.5% in recent years. So keep an eye on these trends as we navigate through 2024. Despite challenges faced by crypto brokers like FTX and regulatory actions against industry leaders such as Binance and Coinbase, the prices of major tokens like Bitcoin and Ether have surprisingly surged, with Bitcoin up 150% this year. In 2024, a significant shift is expected as Bitcoin ETFs are likely to be approved for retail investors, with major players like BlackRock and Fidelity entering the space. Additionally, Bitcoin is nearing another halving event, reducing its already scarce supply. The combination of increased acceptance through ETFs and growing scarcity is anticipated to drive Bitcoin prices even higher, according to Rick Edelman, founder of the Digital Assets Council of Financial Professionals. As we navigate the financial landscape of 2024, the stock market's fate hangs in the balance. With potential shifts in interest rates and economic indicators, history offers insights, pointing to potential market trends amid political and economic events. Meanwhile, the crypto realm defies expectations, with Bitcoin's resilience and the impending arrival of ETFs for retail investors. Whether you're an investor or simply intrigued by these financial dynamics, stay tuned for more updates. Don't forget to like, comment, and subscribe to our channel to stay informed and engage in the ongoing conversation about the ever-evolving world of finance.